Welcome to What's the Risk, hosted by myself, Daniel Crowe, and Peter Mancell, founder of Mancell Financial Group, a financial advice business he founded in 1980. This is a simple video series we hope investors can use to better understand index and portfolio performance, along with addressing some investment questions and dilemmas. This episode is on the MSCI Russia Index net divs in USD. This index doesn't exist anymore in the aftermath of Russia's invasion of Ukraine, so it's really a bit of an oddity to briefly look back on. But the index being removed and Russia being non-investable has led to some issues for investors who own Russia-heavy ETFs because they end up in limbo. So we'll also discuss some things to consider when buying more obscure ETFs. Your Investment Philosophy, a book we wrote, available at Amazon. Disclaimer, please pause and read. Suffice to say, our intent is educational and not rendering financial advice. They make us tap the sign. These are simple concepts. We like investors to better understand risk so they can make informed decisions. Periodic performance. Not often you're going to see a minus 100 one-year return from an index, but it's not a total wipeout for investors in the sense that they've lost everything. It's just the index is now dead and anything tracking it has to be liquidated in trying circumstances. Bit of a strange one, Peter, but that's what happened after Russia invaded Ukraine.
Absolutely. And it's important to recognise that when you have major geopolitical events, investments in regions that become incredibly unstable or indeed globally unacceptable, as Russia's behaviour has been seen to be, people who have taken the risk of investing in those areas run the risk of seeing those investments literally wiped out. We've seen it in other ways with things like the Argentinian bond market back in the 1990s. This is very unpleasant for investors, but it is not new.
And growth of wealth, slightly humorous chart again as it goes to zero, showing that high volatility is a drag on returns. You probably can't compound your way out of Hades, as I think Cliff Asness once said, but while minus 100% means the death of the index and related ETF, something will be recouped by investors, so it's not quite death, just very annoying.
Well, it's also important to recognise that the first few years of this chart show that investing in Russia, which was, inverted commas, some form of greenfield or blue sky opportunity, saw investors rewarded very handsomely from $1 to $26, in the space of 4 or 5 years. That is colossal. But then you see that massive plunge when obviously, Russian behavior was bad. I suspect that that's around the time that they invaded the port regions around Sebastopol, Odessa, and the like. So suddenly Russia becomes very unpopular globally amongst the international community. But then, there's a bit of a recovery again, and we get back to around $25 again. And then the Ukrainian invasion, and it's game, set, and match.
The rolling annual returns. It shows a very volatile index, had some very strong returns. As you know, there was one that was nearly 250% in a year. But as far as I'm aware, I think it had a very small number of companies in it, which probably contributed to the volatility as well.
And, if an investor has even a modest part of their portfolio invested in the Russian index, let's even say they had 2% of their total portfolio in there, 2% getting a 250% return will in fact add 5% to their portfolio. Great. But it doesn't change their life unless they take an enormous risk and allocate a large amount of their portfolio to get that return. These sort of numbers have been seen before, but they're just not sustainable. And for an investor to really benefit greatly from them, they first of all got to have the foresight to predict that it's going to happen. And as soon as it does happen, they've got to have the courage and conviction to say, well, it's not going to continue, so I'm out. They're two very big decisions, and they're damn hard to get right.
On to really what the discussion here is about, and it's around Russia being excluded by all major index providers. And I've just picked out a BlackRock example because there's been numerous managers who've had to go through this with either Russian-heavy ETFs or Russian-specific ETFs. And you can see here in 2022, that's when this all begins. ETFs are suspended from trading. They first have a distribution in June 22, then you got to wait again until August 23, and another one in in November 23. And then there's at the bottom, there's a point there at this time, Russian securities that cannot be divested. They continue to be held in these and or other ETFs with Russian exposure. This is obviously complicated because there's sanctions and other things going on. And for any potential disposal, BlackRock has to continually assess market conditions and legal restrictions, liquidity spreads, investor access, volume, volatility. So this is probably almost the worst case scenario, up there with the type of fund that we probably have seen occasionally that's been gated with liquid holdings that takes a while to get paid out.
Yes, over my nearly 45 years in the business, I've seen some terrible outcomes with frozen funds and that can take well over a decade to wind up. It's a source of continued frustration for the investor that's been caught out by them. It's long-winded, it's uncertain, there are changes, there is uncertainty. It's an awful, awful outcome. We've seen it in mortgage funds. We've seen it in unlisted property funds. Obviously, the example that you're giving here, there's plenty of them. And as a result, I come back to one of our basic tenets in our book, that diversification is an investor's best friend. Concentration risks like this, whilst they can occasionally be very richly rewarded, they are often punished when one looks back through history.
Considerations for ETF and fund long-term durability. Investing does come with risk, and occasionally there's a potential for your ETF to be closed. We have a due diligence process here on every fund we use. It covers the manager, the fund, internals, tax, past regulatory issues, inflows. There's 30 plus categories that I know it pretty well because I've got to do it. I just do the job, Peter. You guys are behind the thinking on why we have a due diligence process on the fund. So what's the thinking behind that?
It's critically important because the extent to which a fund is supported by investors, whether a managed fund or an ETF, will almost always determine its longevity. By way of example, you've got listed there second from the bottom, the Vanguard Multi-Factor Fund. I'm actually personally familiar with the individual charged with the responsibility of establishing that fund. He works out of the Vanguard head office on the east coast of the United States. A particularly clever young man. I would say I have every reason to have confidence, in, first of all, his training, his actual specific career up to date. And they built a product that I genuinely believe was absolutely first rate, but the inflows into that fund were sufficiently modest that Vanguard had decided, well, there wasn't scale within the fund being developed so that it could be run successfully for their business. And without notice, it was just, we're closing the fund. That's it. The due diligence process, looking at funds and ETFs, looking at inflows, outflows, tax positions, all of those sorts of things, critically important, and it's something we take very seriously.
Yeah, I've actually personally looked at that Vanguard multi-factor fund myself, and the only sticking point when I came across it was it didn't have a lot of AUM. I think it was 20 to 30 million. And I thought to myself, I wonder what the staying power of this is. And I think about 12 months later, it was gone.
It's probably not unlike a car manufacturer might design a new model car, specifically for a particular segment of the market. Think, yep, this is going to sell, this will be fine, but no one buys it. And what do? They stop making it.
Some other things to be aware of. Obviously, new issuers coming onto the market. It's not to say that new companies may not be worth investing with, but they may not pick up the level of support needed to sustain themselves.
Well, in the case of the Vanguard fund, their multi-factor fund had a lot of similarities to a number of other incumbents in that sort of multi-factor space. And obviously they were hoping to win market share from those incumbents. But the bottom line was they couldn't win the support of the advisors because they were happy with the incumbents.
Weird themes, they may not last, fads, anything with a history of gating. I suppose mortgage funds and some REITs probably more likely to run into problems when there's some stress around rates and gearing problems and things like that.
The example that you've given on the bottom too, that last point, you've got an index that completely changes the nature of the ETF. I think when we spoke earlier, you talked about the fact that the original index had in excess of 5,000 securities in it, but when they revamped it and call it something else, it suddenly only got 600 stocks in it. Now, that means immediately volatility has to be higher because you've got much greater concentration risk, and it's a world investable index, and it becomes an ESG index. So all the companies that might have been in the original portfolio that don't meet the ESG criteria is out. Here's another tax event coming, ladies and gentlemen. Terrible outcome.
So those are the things to be aware of when you are selecting ETFs, and the lead in was obviously Russia, but it can happen with various different funds for various different reasons, and you don't want to be having your fund change. You don't want to be having it gated. So you've always got to do your due diligence and be cautious with some of the ETFs that you intend to use that are a little bit out there or different.
Indeed.
And sources and descriptions of data. So again, thanks for your time.
Bye for now.